What's up everyone, Dylan here. I wanted to hop on for another episode of the weekly analysis video. With that said, we'll hop right into it. Tomorrow we have a pretty packed day in terms of economic events despite the United States government still being in shutdown. So what that includes is CPI data at 8:30 a.m. It's important to note that that is 9 days delayed because of the shutdown. We also have U.S. S&P Global Manufacturing and Services PMI data at 9:45 a.m. And then we have U.S. University of Michigan Consumer Sentiment at 10 a.m. So again, pretty busy. And it's important to note that this comes ahead of next week's FOMC decision. So next week we have a Fed event on Wednesday. You can see here, this is a public website. You could just go on Google, type in Fed Watch Tool, CME. And you can see next Wednesday, October 29th, we have another Fed meeting. Okay, and at this moment of me making this video, there's a 98.3% chance that Powell cuts rates. So I don't think, despite the fact that we have a busy schedule tomorrow with CPI and other data, I don't think that it's going to move the needle much in terms of whether or not Powell cuts next week. Okay. However, it is still important to watch this heading into next Wednesday. So if this drops below, say, 80 or 75%, it could put some pressure on the market. But as long as it stays above 80%, it should act as a tailwind. Okay. So what's been going on? In the last video that I posted, I talked about how I bought the dip on October 10th near the lows. Between, say, the last 30 minutes of the market close on October 10th. I gave you why I bought the dip, right? What were my pieces of context? What was my thesis? Some of these stocks that I even bought, right? I bought 10 different stocks down there and so on and so forth. So what has happened since then? Since then, it's been pretty choppy, right? Very back and forth volatility, up, down, up, down. But at the end of the day, we can, it's tough to argue against the fact that the S&P and the Nasdaq are resilient, okay? Since October 10th lows, the S&P and the Nasdaq are up 2 and 3% respectively, okay? On top of that, the S&P and the Nasdaq are both less than 1% away from all-time highs, okay? So you would think that people are optimistic, right? Including myself, okay? However, if you look at some of the sentiment data, that is far from the truth. And let me get into it. So if we look at CNN Fear and Greed Index, this thing is on the border of extreme greed or extreme fear and fear, right? As of this moment, it's at 28, okay? And last month, it was in the extreme fear territory, okay? So this is crazy. The fact that S&P and the Nasdaq are resilient, right near all-time highs, but folks are still very, very pessimistic, okay? And, if folks are like, oh, well, that's just, some nonsense index, right? There's no data to back it up. Think twice about that, because let's get right into it, right? This is, now, you can argue, okay, Dylan, well, this is from last week, but it still doesn't matter, okay? And let me explain, okay? So you guys have to understand that mass liquidation day, right, where I bought the dip was on October 10th, okay? Since October 10th, the market has gone up, right? I've said that already, okay? So this data right here from Goldman Sachs, right, is after October 10th. This is the week after October 10th. So despite the market continuing higher highs, higher lows, folks are still relentlessly selling, okay? Hedge funds net sold U.S. equities at the fastest pace since early April, driven by short sales in macro products and single stocks, right? U.S. ETF shorts saw the largest percentage increase in 5+ months, and the 7-week net buying streak in single stocks came to a stop. On top of that, right, both asset managers and hedge funds finished the week better for sale at negative 1.7 billion and negative 2 billion, respectively. Okay, on top of that, Nasdaq, right, in terms of futures, significant futures liquidation and put demand were key drivers as aggregate open interest shed negative $5.1 billion, right, one of the largest drops year to date, excluding roll periods. Okay, on top of that, right, you could pause this, read it if you want, but on top of that, we go down here and you can see this is just kind of the same information, just worded, much more, in a summarized manner, right? Hedge funds net sold U.S. equities for a second straight week at the fastest pace since early April, right? -1 standard deviation relative to the norm, right? Macro products, index, and ETF made up nearly 80% of the total net selling, right? Single stocks were modestly net sold for the first time in 8 weeks, driven by short sales outpacing long buys 1.5 to 1. Okay, and then I have a picture here from Deutsche Bank. So this is from Goldman Sachs, and then here's Deutsche Bank. You could see the weekly drop is the largest since Liberation Day in terms of equity positioning. Okay, again, this is after the market bottomed, right, on October 10th. This is since then. Okay, so despite the market continuing higher, 1%, less than 1% near or lower than all-time highs, folks remain very bearish. Okay, and if you're going to listen to anything I say in this video, make it be this. Okay, people are pessimistic, fearful. Okay, folks are selling the market relentlessly, shorting, not even just selling long, right, longs, but actually initiating more and more and more shorts. Okay, what does this tell you? Okay, this is very important. Okay, those people are not getting rewarded. So as the S&P and the Nasdaq get closer and closer to all-time highs, what's going to happen, right? It sets up for a potential short squeeze, right? Picture you are relentlessly shorting every single drop, right? Including yesterday's drop, right? Picture you continue to short. When's the stop out point? In my eyes, it's all-time highs. So being that the S&P and the Nasdaq are resilient near all-time highs, right? Doesn't it make sense that those folks will have to cover their shorts and the market will kind of get fuel to the upside, right? That's where I'm coming from. Is it guaranteed going to happen? No. Okay? But heading into the fourth quarter, or we're in the fourth quarter, heading into the last week of October, I showed you seasonality charts last week's video. Heading into that positive seasonality, right, where you have some supportive flows, right, it can exacerbate that negative positioning. Okay? On top of that, 22% of fund managers are beating the market this year. 22%. That's the lowest in decades. I forget who said that. I like to give credit where credit's due. But that means 78% of fund managers are losing against the market. So what does that set up for? It sets up for the potential to window dress, right? You type in on Google, what is window dressing, right? Window dressing, I'm going to try to put this in the clearest form possible. Window dressing is basically making your books, right? Making your hedge fund books, right? Your positions in your hedge fund managers, right? Making your positions look appealing to potential investors, right? What do I mean by that? If 78% of funds have been underperforming relative to the S&P year to date, right? And we're in that last window of the market, what ends up happening usually is fund managers will sell off their underperforming stocks, right? The underperformers year to date, and they'll buy the leaders of the year to date, in the year, okay? And what that does is it adds extra flows into those leaders, which ultimately have a ton of influence in terms of moving the market higher, right? They'll buy, the best year-to-date performers. And the reason they do that is because when they go to pitch themselves to potential investors, right, those investors are going to say, wow, these guys have, the best year-to-date performers on their book. They must be doing something really, really well. Little do they know that they just, rearrange their books leading into that fourth quarter. Okay, so ultimately it is bullish near term as they start to chase those year-to-date high, leading performers. Okay, so that can act as another supportive flow for the market. Okay, and again, it's more near term as they're just doing it to fluff up their books leading into that last quarter, but still, it's something worth noting. Okay, Then we have this picture here, okay? Nasdaq 100 index seasonality. This is pretty similar to what I showed you from last week, right? I showed you guys a picture from Scott Rubner from Citadel, but Goldman Sachs says this. Goldman Sachs with a gentle reminder. The average S&P 500 return from October 20th to December 31st since 1928 is positive 4.16%. The average Nasdaq return from October 20th to December 31st since 1985 is 8.48% positive, okay? So that's where we are as of today in terms of the Nasdaq 100, right? Seasonality, chances are, again, this is from, I guess we're going to use Goldman Sachs, 1985, okay? Is it guaranteed? No, but when you have total pessimistic investors that continue to relentlessly short with a stubborn bias, S&P, Nasdaq right near all-time highs, those folks aren't getting paid on the short side, and they're very, very vulnerable to having to cover for a loss, driving the market higher, right? Fed's cutting rates next week, right? There's $7 trillion worth of money in the money market funds, right? The money markets are getting less appealing each time that Powell cuts rates, right? Where's that money going to move to? The S&P and the Nasdaq, right? There's different factors that are really lining up where the folks that are really, really short, and the fact that hedge funds are net selling at the fastest pace and that only 22% of fund managers are beating the market, right? It is the most hated rally in plain English, okay? And again, to me, that's pretty bullish, okay? So let's say I am wrong and the S&P and the Nasdaq do manage to come off, okay? The main level that I've been putting in the Discord, right, is 6,700 in the S&P, okay? Very, very simply put, above that is bullish in plain English, okay? Let me just show you guys. This was from yesterday. Let's see. This is what we got. 6,700, bulls control above, neutral below for me, okay? This was posted yesterday. And you could see, right, S&P got right down to that 6,700 and bounced, okay? So going forward, 6,700, as long as bulls stay above that, as long as price stays above that and bulls continue to defend dips into that or above that, the bulls control. If that 6,700 were to get breached, right, and price breaks below, I am personally more on the neutral side. So I wouldn't say I'm bearish below 6,700. I'm more neutral as price will go back into this chop, neutral territory, right? Where it's very, very lackluster, okay? So below 6,700, I am neutral. Below this level on the Nasdaq is where I start to get more bearish, okay? So if and when S&P futures breach below 6,700, right, it goes into neutral territory. It's neutral until the Nasdaq gets down to that 24,422. Below that, I do believe that the selling pressure can pick up, where you get the sentiment changing from buying the dip to selling the rip. Okay, so that is my bull/bear line in the sands. Okay, so again, am I leaning bullish? Yes. Okay, I told you guys last week that I bought the dip on October 10th. Okay, so I am positioned for continuous upside leading into November, December. However, if and when 6,700 gets broken to the downside, neutral, and then below that NASDAQ double bottom area is where I start to get a little bit more bearish, where I am open to continuing to buy the dip, but that's where I see the market selling off at a faster pace, okay? And basically, if that blue line on the NASDAQ gets broken, I think it would be inevitable for the market to test that October 10th low, okay? Going forward, I wanted to look at Bitcoin relative to the Nasdaq. So this is from Mr. Derivatives, aka Heisenberg, on Twitter. You can see up until recently, the Nasdaq and Bitcoin have been have moved in tandem since April lows. Okay, again, up until recently. So basically, Heisenberg says something has to give, right? It's either is Bitcoin going to go up, or is QQQ or Nasdaq going to go down? Okay, and something that I wanted to make note of is, first off, if Bitcoin does go higher from here, that will be a net positive for the Nasdaq and the S&P. If Bitcoin continues to the downside, where it goes down to that 100,000 level and keeps going to the downside even beyond that, that should put additional pressure on the S&P and the Nasdaq, ultimately dragging it down. Okay. However, what I wanted to know is the spread between Bitcoin and gold. Very, very interesting. Okay, so Bitcoin relative to gold got down to a key level that has been very, very influential since the election. So last year's election, right, 2024 election, was November 5th. Okay, that was where this down here was. Then the lows from Liberation Day, right, Liberation Week, I should say, were here. It literally lined up perfectly with that election low. What do you know? We got down here again this week, and we bounced yet again. So what this implies is that Bitcoin will start to outperform gold. Does not mean that Bitcoin's going to go up and gold's going to go down. They could both go up. They could both go down. All it means is that Bitcoin will outperform gold. So if they both go down, Bitcoin will go down less. If they both go up, Bitcoin should go up more, right? It'll just outperform, right? Very, very important to know. So as long as that area, right, from Election Day and Liberation Week continues to get bought, I would expect that Bitcoin will be pretty supportive, okay? And I would think that Bitcoin is going to not only outperform gold, but also allow for the S&P and the Nasdaq to stay stabilized, okay? If and when this area gets broken, right, that would put additional pressure on Bitcoin, right? Make it go lower, down further, and then put pressure on the S&P and Nasdaq. But again, this area, if supported, is a net positive for the S&P and the Nasdaq, okay? So that's that. And then important to note that President Trump and Chinese officials are kicking off tomorrow in Malaysia, right? So senior U.S. and Chinese officials kicks off in Malaysia tomorrow as both sides look to stabilize the economic relationship and set the stage for a successful Trump-Xi summit next weekend in South Korea. So what I said last week was that, expect headlines to be pretty volatile in terms of pricing metrics leading into the Trump and Xi meeting. So I still think that that's going to be the case. You might see some headline bombs, but ultimately, as long as you keep an eye on 6,700 S&P, I think it gives you a good gauge in terms of what side of the spectrum is in control, bulls or bears. So hopefully that's helpful to the upside. Main areas to watch are all-time highs in both the S&P and the Nasdaq futures or cash, whatever you want, whatever floats your boat. But those are the main areas that I will be watching. So hopefully this video is helpful. Those are the key areas to look out for. And again, you got to ask yourself with those, all those shorts factored into the market, what is going to be the net result of that? Okay, I told you guys my stance, and I stand by that, and I will be using that 6,700 near term in the S&P to gauge whether or not bulls are in control or not. Okay, so that's it for me. If you guys like this video, please give me some feedback. I also did a recent podcast with Words of Wisdom. It was my first solo podcast, so it was pretty cool. I'll put the link for that as well in the description if you guys want to check that out. And I will talk to you guys soon. Peace.